All right, let's go. Here we go. The allowance method. Apply the allowance method to accounts receivable. The allowance method for bad debts matches the estimated cost or estimated loss from uncollectible accounts receivable against the sales they help produce. We use estimated losses because when sales occur, sellers do not know which customers will not pay. This means that at the end of each period, the allowance method requires an estimate of the total bad debts expected from that period's sales. This method has two advantages over the direct write-off method. One, it records estimated bad debts expense in the period when the related sales are recorded. And two, it reports accounts receivable on the balance sheet at the estimated amount to be collected. Recording bad debts expense. The allowance method estimates bad debts expense at the end of each accounting period and records it with an adjusting entry. TechCom had credit sales of $300,000 in its first year of operations. At the end of the first year, $20,000 of credit sales were uncollected. TechCom estimates that $1,500 of its accounts receivable is uncollectible and makes the following adjusting entry. How to estimate bad debts is explained in that next section. On December 31st, bad debts expense is debited for $1,500, while allowance for doubtful accounts is credited for $1,500. This is to record the estimated bad debts. The estimated bad debts expense of $1,500 is reported on the income statement as either a selling expense or an administrative expense. The allowance for doubtful accounts is a contra asset account with a normal credit balance. All right. TechCom's account balances for accounts receivable and the allowance for doubtful accounts follows. Accounts receivable will be debited on December 31st for $20,000, and allowance for doubtful accounts seems to be credited for $1,500 on December 31st. Hopefully I'm reading that correctly. I'm just basing that on which columns they're putting it in. The allowance for doubtful accounts credit balance of $1,500 reduces accounts receivable to its realizable value, which is the amount expected to be received. Although credit customers owe $20,000 to TechCom, only $18,500 is expected from customers. TechCom still bills its customers for $20,000. In the balance sheet, the allowance for doubtful accounts is subtracted from the accounts receivable and is reported in either of the following ways. So the first option is where current assets, we have current assets here. Accounts receivable is debited for $20,000. There is less allowance for doubtful accounts, $1,500, reaching $18,500. Or accounts receivable, the net of $1,500 doubtful accounts, and then results in $18,500. Writing off a bad debt. When specific accounts become uncollectible, they are written off against the allowance for doubtful accounts. TechCom decides that J. Kent's $520 account is uncollectible and makes the following entry to write it off. On January 23rd, allowance for doubtful accounts is debited for $520, while accounts receivable for J. Kent is credited for $520. This is to write off an uncollectible account. Okay. The main point here is that bad debts expense is not debited in the write-off because it was recorded in the period when the sales occurred. This entry removes $520 from the accounts receivable account and the subsidiary ledger. The general ledger accounts appear as follows. In accounts receivable on December 31st, we have a $20,000 debit. On January 23rd, $520 credit. In the allowance for doubtful accounts, we have on December 31st, $1,500 credit and a January 23rd, $520 debit. The write-off does not affect the realizable value of accounts receivable. See Exhibit 9.5. Neither total assets nor net income is affected by the write-off of a specific account. Instead, both assets and net income are affected in the period when bad debts expense is estimated and recorded with an adjusting entry. Exhibit 9.5, before and after write-off of a bad debt. For accounts receivable, before the write-off, we have $20,000 and then less allowance for doubtful accounts, $1,500. The realizable value of accounts receivable is $18,500. After the write-off, accounts receivable shows $19,480. $80, and the less allowance for doubtful accounts shows $980, also resulting in $18,500 of realizable value of accounts receivable. Exhibit 9.6 portrays the allowance method. It shows the creation of the allowance for future write-offs, adding to a cookie jar. It also shows the decrease of the allowance through write-offs, such as, or in other words, taking from the cookie jar. Exhibit 9.6, allowance for doubtful accounts. Increasing allowance is seems to be like the adding to the cookie jar. We got adjusting entries, you dump it in the cookies. Allowance for doubtful accounts, that's your little cookie jar. Okay. Bad debts expense, allowance for doubtful accounts. Adjusting entries add to allowance for doubtful accounts. A decrease in allowance is like taking from the cookie jar. We got write-offs, which is like the hand removing a cookie. And the cookie jar is the allowance for doubtful accounts again. Write-offs are basically just removing the cookies, at least in this analogy. So decrease in allowance, there's allowance for doubtful accounts, and then accounts receivable for J. Kent. Bad debt write-off subtract from allowance for doubtful accounts. Recovering a bad debt. If an account that was written off is later collected, 2 entries are made. The first is to reverse the write-off and reinstate the customer's account. The second is to record the collection of the reinstated account. If on March 11th, Kent pays in full the account previously written off, the entries are on March 11th, accounts receivable to J. Kent is debited for $520. Allowance for doubtful accounts is credited for $520 to reinstate the account previously written off. On March 11th, same day, same time, pretty much just right after. It's like part of that phase of transactions. Cash is debited for $520, while accounts receivable for J. Kent is credited for $520. This is to record the full payment of account. Kent paid the entire amount previously written off, but sometimes a customer pays only a portion. If we believe this customer will later pay in full, we reinstate the entire amount owed to accounts receivable in the first entry only. If we expect no further collection, we reinstate only the amount paid. Allowance method versus direct write-off method. The following table compares the accounting using the allowance method to that using the direct write-off method. So on the left-hand side, we have the direct write-off method. During the period end adjusting entry, there is no adjusting entry. For writing off a bad debt, there would be a bad debts expense of $520, and accounts receivable to J. Kent of credit of $520. And then for recovering bad debt, the accounts receivable for J. Kent will be debited for $520. Bad debts expense will be credited for $520. And then cash will be debited for $520, while accounts receivable for J. Kent is credited for $520. In the allowance method, the bad debts expense during the period end adjusting entry will be debited $1,500. That's the bad debts expense. And then allowance for doubtful accounts would be credited for $1,500. For writing off a bad debt in the allowance method, there would be a $520 debit to allowance for doubtful accounts and a $520 credit to accounts receivable for J. Kent. The accounts receivable for J. Kent would then be debited for $520, while the allowance for doubtful accounts is credited for $520. And then that's part of recovering a bad debt. And then cash would subsequently be debited for $520, while accounts receivable for J. Kent is credited for $520. In the allowance method, there are advantages and disadvantages. Advantages include 1, receivables are fairly stated. 2, bad debts expense are matched with sales. And 3, writing off bad debt does not affect net receivables or income. The disadvantages include that estimates are needed. Using analytics insight, customer analytics, financial institutions and credit card companies such as Capital One and Citi Group, whatever that is, some banking institution, use data analytics to predict the risk of extending credit to customers. When evaluating a customer, they use analytics that include credit scores, income, employment, and payment history. Analysts use these data points to create models that predict the probability of default and expected loss for each customer. Data analytics can also help banks monitor their credit portfolios and identify emerging risks across customer segments. Here's a need to know. You need to know this. A retailer uses the allowance method. Record the following transactions. On December 31st, the retailer estimates $3,000 of its accounts receivable are uncollectible at its year end. On February 14th, Valentine's Day. So we got New Year's Eve, Valentine's Day, and April Fool's Day. December 31st, February 14th, and April 1st. February 14th, the retailer determines that it cannot collect $400 of its accounts receivable from a customer named ZZZ Company. On April 1st, ZZZ Company unexpectedly pays its account in full to the retailer, which then records its recovery of this bad debt. The solution here is that on December 31st, bad debts expense will be debited for $3,000. The allowance for doubtful accounts will be credited for $3,000 to record the estimated bad debts. On February 14th, allowance for doubtful accounts is debited for $400, while accounts receivable for ZZZ Company is credited for $400. This is to write off an account. On April 1st, we have two different transactions here. For accounts receivable for ZZZ Company, we have a debit of $400 and a credit of $400 to allowance for doubtful accounts. This is to reinstate an account previously written off. Then on April 1st, we have a cash debit of $400 and a accounts receivable for ZZZ Company credit of $400. This is to record cash received on credit. All right, that is the allowance method, right? Yeah, allowance method. Boom. Winner, winner, chicken dinner. Just kidding, I'm having turkey.